All right, there's a saying out there in the startup industry, the founders are always fundraising, but that fundraising, well, it's been under pressure for the last few months here. We've seen mass layoffs in that space, plummeting VC investments, and of course now the turmoil in the banking system, raising a lot of questions here about what the future is. Our next guests actually say that, well, the VC industry can maybe use a little bit of shaking up, a little bit of a refocus. Robert Cote joining us right now. He's the founder and CEO of Cote Capital. Also joining us is Sam Yegan. He's the co-founder and managing director of Corazon Capital. Robert, I'm going to start with you here. I mean,
Sure.
We talk about some of the funding rounds that we've seen. They're taking longer to complete. We're seeing pressure for some of these down rounds here. What's the state of business right now when it comes to VCs?
Well, I would say that venture capitalists have kind of been on a software focus for 20 years, and they're seeing a down economy that's kind of extending the lack of exits. Exits have drawn out, and without exits, obviously, returns are poor. And so there's a big push in the world, in the economy, to move us to making physical products again, moving away from software to breakthrough innovations that we can manufacture and bring manufacturing home.
Well, Sam, come into this conversation because I'm curious. Are we actually doing that? I mean, when I look at least some of the big unicorns out there and you go through some of the data here, I'm not necessarily sure that I see that type of breadth.
No, I think we're still seeing the same emphasis on software that we've always seen. And in fact, no conversation about the current state of VC can be complete without the letters AI. And I actually think we're on the cusp of a huge, new, innovative trend in software investment. So I think we're certainly in a lull right now, but I think software is going to be as strong as ever coming out of this.
Well, put that in context for us, Sam. When you talk about AI, I mean, give us a sense of what that really means. Because to the layman, I think the definition of that, and more importantly, the end use case for that, has been a bit distorted.
I do think that AI is a very hard field to invest in right now because it's so unknown. I think back to the beginning of the internet back in the 90s. The internet allowed us to do things we had never even imagined the ability to do before. And I think AI is going to offer the same set of opportunity. About a third of the deals that we see right now have an AI component to it. And that's happened just in the last 3 to 6 months. So the founders always know where to go for the most opportunity.
Right.
And when we see founders making a mad rush, that's a sign of what's to come.
Robert?
I would say he's right. AI is where software is headed. I'm going to say that he's also right that we haven't moved venture capital from software back over to hardware, to manufacturing breakthrough products again, kind of going back to the physical world, the way the empire was built in the first place.
Yeah.
And we're seeing competition from China we didn't see before. And unless we pay attention, venture capital, not just to AI and software, but to the physical side of the house, we're going to have trouble long term.
But where are the opportunities? Because right now, whenever we talk about this, at least on this program, it's always about the big companies that are already established, you know, the Amazons and Googles and Microsofts of the world, if you will. That layer of companies, sort of meaning those smaller companies, those startups here that might actually end up being the engine of this, where are they?
So they're here. They're struggling for capital today.
Yeah.
And basically what you're seeing is sustainable development goals are driving big companies, and big companies are being pushed to figure out, how do I make things in a sustainable way? How do we reuse my waste?
Yeah. Sam, I'll come back into this conversation as well, because when I think about sort of where the opportunities end up being here, and more importantly, the skin in the game that these VCs are going to have in this, give us some sense of that balance.
VCs are having to preserve their own capital. Don't forget, VCs are fundraisers themselves. And so I think right now what you're seeing in the market, and one of the things really driving the reduction in pricing that we're seeing in deals, is the VCs are being much more discriminating in the deals that they fund. You're no longer seeing this mad rush to get multiple term sheets into a deal as quickly as possible. More and more VCs are sort of stepping back and saying, I don't need to rush into this deal. I'm going to wait and let the deal come to me. And that's one of the reasons what we've seen, deals are taking about twice as long to close in 2023 than they did in 2022.
What are they asking of the founders and the executive teams at these companies right now? In the past, it was basically just growth at any cost, and I know that era seems to have come to an end.
That turned on a dime. Right now, it's sustainable growth. Doesn't have to be profitable growth on day one, but every investor, certainly here at Corazon Capital, we are just focused on how sustainable is the growth and how quickly can the company be profitable if it needs to be.
Robert, I am curious here about that sort of exit, right? I mean, there was sort of this funnel that was coming out of the private space, the VC space, into the public markets, and we know that's basically been choked off. Do you anticipate that we could maybe potentially start to see some of these companies enter the public space?
Actually, I don't think so.
No.
Actually,
Why not?
I think that these companies, these software companies, are struggling. There's many choices. It's hard to get the right price when you exit. And so again, I'm going to go back to the physical side of the house that I really think is where we're headed. That's where your unicorns will be. Those are the companies that are driving sustainability and manufacturing. They're driving circularity and renewable energy sources. And so that's where you get the efficiencies and how we make things. It allows us to create the profitability from efficiency, bring manufacturing back to the U.S. And that advanced manufacturing is aligned with the skilled workers in America. So we have the ability to rebuild our manufacturing base through breakthrough innovation, and many of these companies are being pulled outside the United States where they can get the capital, where the manufacturing exists today. We don't want to lose. We've already lost our old growth forest. We want to bring back and make sure we take care of our new growth. And while AI may be the hot thing and software may continue to persist, you have very, very low barriers to entry in software. It's very hard to exit those companies because even the best deal can have many, many Me Too's along the way. And when it comes time to exit, you've got troubles.
I appreciate it both. We can go on for 10 minutes. Unfortunately, we're up against a break. Robert Cote here, one of the best in the business when it comes to intellectual property. Sam Yegan, a serial entrepreneur here, and now, of course, the leading Corazon Capital. Thanks to both of those men. Coming up after the break, John Taylor joining us with a breakdown of the economic picture. This is Bloomberg.